Wondering how to analyze an investment to avoid unpleasant surprises? Discover the best practices for evaluating your options before taking the plunge. In this video, we'll explore best practices for analyzing an investment and give you the tools you need to make informed decisions. Stay with us to the end for essential tips that can transform your approach to investing. Before we dive in, don't forget to subscribe to our channel for more practical advice on investing and finance. Analyzing an investment is a fundamental step for any investor, whether you're a beginner or an experienced one. Here's why a thorough analysis is crucial to your financial success. Identify potential risks first. Careful analysis helps you spot red flags that might indicate an investment is riskier than it seems. For example, if a company is showing signs of financial difficulties, or if a market is particularly volatile, these elements need to be taken into account to avoid potential losses. By studying market trends and historical performance, you can avoid falling into traps that other investors have encountered, such as investing in overvalued stocks or declining sectors. Choosing the most promising investments. A detailed analysis helps you identify opportunities with the best growth potential. This means you can focus your money on investments that not only offer a good return, but are also aligned with current market conditions. Entry and exit strategies. By understanding market dynamics, you can better plan when to enter and exit an investment, maximizing your profits and minimizing your losses. Consistency with your financial objectives. Every investor has different financial objectives, whether for long-term growth, passive income generation, or capital preservation. Rigorous analysis helps ensure that each investment supports your personal objectives and respects your risk tolerance. Long-term planning. By aligning your investments with a well-defined overall strategy, you can stay on track to achieve your financial goals, even when the market goes through turbulent times. In short, thorough analysis is essential not only to minimize risk, but also to maximize returns and ensure that your investment choices match your needs and financial goals. Best practices in investment analysis. Analyzing an investment requires a methodical approach to ensure that you make a wise choice. Here are the key steps to a thorough analysis. Assess the financial health of the investment. The first step in analyzing an investment is to examine its financial health. Here's how to do it. Analysis of financial statements very important. Examine the financial statements, analyze the balance sheets, income statements and cash flows of the company or investment fund. This will give you an overall picture of its financial situation. Pay attention to detail. Look for signs of financial stability such as steady revenue growth, sound debt management and sufficient liquid assets to meet short-term obligations. Key financial ratios. Liquidity ratios measure the company's ability to cover short-term debts. The current ratio and the quick ratio are two important measures to monitor. Debt ratios. Evaluate the ratio of debt to assets. A high debt-to-asset ratio may indicate increased financial risk. Profitability. Analyze indicators such as return on investment, ROI, and profit margin to assess the company's ability to generate profits. If you're considering investing in a company, check its balance sheet to make sure it has sufficient assets to cover its debts and is generating consistent profits. For example, a company with strong cash flow and low debt is generally more stable and less risky. Analyze growth potential. Having assessed financial health, the next step is to understand the investment's growth potential. Here are the criteria to consider. Market and competitive analysis. Evaluate the target market, research market growth trends and identify potential opportunities. An expanding market with little competition may offer excellent growth potential. Study the competition. Understand the strengths and weaknesses of competitors to identify the competitive advantages of the company or fund you are considering investing in. Growth plans: examine the company's or fund's growth strategy. An innovative company with a clear, well-defined growth strategy is often a sign of solid future potential. Investment in innovation: analyze whether the company is investing in research and development, R&D, to stay competitive and adapt to market changes. For a technology startup, analyze its innovation plan and growth projections. Make sure it has a clear strategy for capturing new customers and expanding, such as launching new products or expanding into new markets. If you find these tips useful, like this video and subscribe for additional investment and financial management recommendations. Assess the associated risks. A complete analysis should also include a risk assessment. Here's how to identify and assess risks. Consider economic risks. Factors such as interest rate fluctuations, regulatory changes, and economic cycles can have a significant impact on your investments. Trend analysis: study macroeconomic and geopolitical trends that could affect the industry or sector in which you invest. Assess the company's ability to manage its operations effectively and maintain its market position. Make sure the management team has solid experience and a track record of success. For technology companies, consider the risk of rapid obsolescence and the company's ability to innovate continuously. If you're investing in the shares of a fast-growing company, be aware of the risks associated with market fluctuations and the specific challenges the company may face, such as rapid technological change. We need to analyze costs and expenses. Fees and costs can have a significant impact on your returns. Make sure you understand these aspects. Check all costs associated with the investment, such as management fees, commissions and transaction costs. Compare the fees of different funds or investment platforms to make sure you choose an option with reasonable fees. Calculate how fees will affect your net returns over the long term. High fees can significantly reduce your potential gains. For an investment fund, compare management fees with those of other similar funds. High fees can reduce your net returns, so choose options with competitive fees. Consider reviews and recommendations. Finally, consider the opinions and recommendations of experts and financial analysts. Here's how to use them effectively. Read financial analysts' reports and expert ratings to get an outside perspective on the investment. Consider expert opinions on future investment performance and market forecasts. Consult the opinions of other investors to understand their experiences and recommendations. This can provide practical insight into past performance and future expectations. Before investing in a new financial product, read expert reviews and recommendations to assess credibility and performance forecasts. Thorough research can help you avoid making hasty decisions based on incomplete information. To sum up, careful analysis from financial health to risk assessment, fees and expert opinions is essential to making informed investment decisions. If you found these practices useful, subscribe to our channel for more investment and money management tips. By applying these analytical practices, you'll be better prepared to make sound investments. Take the plunge with confidence and take control of your financial future today.